Hey, Money Multipliers. Welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? Every week I'm here, uploading on Tuesdays, delivering the most up-to-date knowledge and information, specifically when it comes to the realm of the infinite banking concept. So what perfect person to bring on this episode where I want to talk about why does whole life insurance get such a bad and negative reputation when it offers such incredible value and the benefits that come from a whole life policy with a mutually owned insurance company that has been around for a long time. So what better guest to bring on than another IBC Infinite Banking Concepts practitioner, Mr. Curtis May. So he actually has a podcast too, the host of the Practical Wealth Show, and also his company is Practical Wealth Solutions. So go look up Curtis, see what he's up to. He's a wealth of knowledge. He's fun. That's why I like him. He's just got that humor, that down to earth, wants to go kick it around a campfire and roast marshmallows and drink a beer together type of guy. So he's really cool, and he's a coach. He has children, married. He just has gone through so much in his life to get him to where he's at, and the knowledge that he has when it comes to creating a personal monetary banking system. So welcome, y'all, Mr. Curtis, to my show. And hey, if you haven't already, hit the subscribe button, like, comment down below. Tell me your thoughts. I want to hear the questions from you. And this allows me to keep delivering more information, more case studies that you want to see. So it's always a pleasure to see you, but let's get into the episode with Curtis. Money Multipliers, please help me welcome Mr. Curtis May. How are you doing, sir?
If I was doing any better, I need to be twins.
No, so we had a lot of fun on your show. Hey, plug your show real quick. Where can people find your
So
podcast?
my show is the Practical Wealth Show. So you can find me anywhere you listen to podcasts, YouTube, uh, Instagram, wherever, right? But basically it's called the Practical Wealth Show. Yeah, if you search Curtis Mayfield, the singer is going to come up, but below him, I come up. So I haven't been able to knock him off the top spot. But just search for the Practical Wealth Show.
You gotta start warming up those vocals, man. You gotta start.
Yeah, yeah,
You
you know. I think my
know.
parents were fans, but I can't sing. So
Just with the
what's your
two,
name?
we need to like two beverages in us, and then we can go hit karaoke night.
Yes. Couple of tequilas, I think I'm a stand-up comedian. So
Hey, a couple of tequilas. I think I'm a gymnast.
there you go.
That's fun. And so your company, the Practical Wealth Solutions, I sometimes call y'all the Practical Wealth Advisors. So you started your infinite banking journey, some time ago. I guess before we kind of get into what I would love to talk about today. And
Mhm.
so for all my listeners, one of the things I really kind of want to cover is, hey, why does whole life insurance get such a bad and negative rep when it offers all of this incredible benefits and solutions and values to people, really taking back the control of their money? So we're going to kind of go through debunking some of the myths, some of the noise that we hear out there.
Right.
But before we get into it, I guess tell me your journey.
So it's interesting because I was one of those people that I thought whole life was the devil. Okay. And so I started out in a company, if I named it, well actually I started out in A.L. Williams, okay. And 19 blah 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 85, okay. And I was a junior in college and I realized the NBA was not looking for 5'11" shooting guards. So I had to, I to I had to pivot, because I was like, okay, this whole basketball dream is not going to work out. I got my insurance license, and then I learned But I was fortunate. Well, they're gonna help me. My family had always been self-employed, so I never got that go get a good job talk. My family owned a supermarket, and I heard from the time I was like 7, boy, you'll never make any money working for somebody else.
Well, yep.
So, but the first half of my career, I was like Dave Ramsey on steroids. Buy term investor difference, mutual funds are the greatest thing since sliced bread. And then I read a little purple book called Rich Dad Poor Dad
Yep.
in around 1999. And then I was like, wait. Then I realized what he's talking about and what I'm doing is different. Okay. And then I don't know how, then one of his tapes, this is real interesting because one of his early cassette tapes, I'm dating myself, y'all. It was Rich Dad's Guide to Investing, and who was on the tape was Kim Butler.
Mm-hmm.
And then, and he was doing his other thing he had, Choose to Be Rich. And then somewhere in that time, I also found, I don't know where it came from. I got an email of PDF of Becoming Your Own Banker.
Mm-hmm.
And I think this is interesting. I remember calling up a client. I remember showing them. I'm all excited. And then I realized I had no idea what I was talking about. Didn't know what it was. Didn't know how it worked. I just thought this was interesting. And it still took me several. I didn't really start doing it. I ran into gentleman named Patrick Donahoe from Paradigm Life.
Mm-hmm.
Somehow we found each other in a webinar. And that's how around 2010, that's where I learned how to work virtual and the whole thing, working with him and uh that was my journey. And it's funny because it took me when I first discovered it, even when I left the company I was with, I still took me 3 or 4 years to let go that permanent insurance was the devil,
Mm-hmm.
right?
Yep.
So, I'm one of those people that uh I had to unlearn most of what I thought was true. And
Mm-hmm.
it wasn't instantaneous. It was and you really can't talk anybody out of it. I kind of had to educate myself out of it because after that, then this might be a longer story. Then I discovered IULs, right? And
Right.
so I didn't know the difference. And then it was like, okay, this I don't like this. I don't believe this is, you know, is going to work, right? And and then Patch was like, listen, we don't use IUL. You don't really do that. And I didn't. This is before, the Nelson Nash Institute. So I would get recordings of the old think tanks.
Yeah. Yeah.
And but I didn't know.
Live. Remember when Nelson would do like a 6 hour, 3 day workshops and
Yeah,
all?
I went to those. I
Mm-hmm.
went to though he was in near me. It's like 4 hours away in Wilkesboro with a great advisor, Tim Urick. And so Tim was gracious enough to let me come to his thing twice. So I sat through. I only went. I know y'all been through it. Your dad's like been through it like probably a lot. 15, 20 times. I
Yep.
work with Joe Pantozzi. When he would come to Vegas, Nelson would stay with them. So, he studied under him for 18 years. So he was like my new mentor to help me kind of, okay, here's how this thing works, supposed to work,
Mm-hmm.
because
Yep.
I had reached a level and I also dumb Hannah. I would so how you take a loan, right? And
Yep.
you want to be an honest banker. So you borrow 4,000. I would sorry, let's send back 4,500 because we're gonna be the bank. But nobody told me anything about a PUA rider. And and all of a sudden I did it twice because the company kept sending the money back and I didn't, you know,
Like, why are you sending this money back?
right,
Like,
right, sends money
it.
back. I want to be the bank, right?
Yeah.
So, so it's a system of money management. It's not a magic money box. As
Yeah.
you talk about why people don't they and so I know we talked about it before. Both our pet peeves are the half truths, all the noise out there about. So it's two parts. It's the noise of why it gets a bad rap,
Mm-hmm. Mm-hmm.
but it's the noise of people hyping it up.
Yes.
I don't know which one is worse. I think that the hype is worse. The 90/10s and all of or the people that say, "Bam, I almost punched this guy in the face." I said, I was at some conference. Said he mentioned IUL and infinite banking or be your own banker in the same sentence. I was like, well, nope, nope, I'm about to punch you in the mouth. You
Yep.
can't, that's blasphemy. You can't
Have
say
you
that.
read Nelson's book, Becoming Your Own Banker? He shares his thoughts on there.
Yeah. I was like, he says don't do it. So, I mean, you obviously haven't read the book,
Mhm.
right?
Mhm.
People say as well, I could get a better uh
Rate of
rate
return.
of return. But in the book, you haven't read the book. He says it's not about rates of return.
Yep.
It's not
That's it.
about investing.
Yeah.
About the fact you finance everything you buy. It's an exercise in logic,
Yep.
imagination, and prophecy.
Yeah.
And so people don't read the book because they're lazy.
I think so too.
They're
Some
lazy. It's 85 pages. It's barely a book.
Yeah, yeah. Like even my folks, and actually, y'all, for all my listeners, I did do an episode with Curtis on his podcast show. So go tune into that, and this will make, I think, more sense.
Right,
But
right, right. So we're
it,
talking back to each other. We've already looked.
I know, because we're supposed to do a part two at some point, and we'll get
Yes,
that
yes,
done.
yes.
But oh gosh, where was I going with that? What did you just tell me about the noise and about
The bad rap, the half truths, the
Oh, and I had a specific point, but anyways, if it's important, it'll come back to me. But here's my question, especially you being maybe, if I can call it, a Dave Ramsey's baby step follower. My father was that too. That's
Mhm.
why it took him so long to just even make the leap. Honestly, it was just faith of his colleagues who were doing this, and they were hooting and raving and hollering about this concept. Brent was like, well, I don't know too much about it, but hey, you guys are successful chiropractors, so I'm going to follow and see what you guys are up
Right.
there and you guys are doing. So I think the biggest misconception, specifically when we're talking about the buy term and invest the difference, it is a good strategy to help people get into the mindsets of living below your means, which I think is
Mhm.
fabulous. Everybody needs to do that. You do
Mhm.
need to protect yourselves because sometimes maybe you are just in a financial hamster wheel and you can't afford a whole life policy right now. That's totally okay. Get yourself some term, even convertible term is my opinion.
Only convertible term, I say.
Only convertible.
Okay.
Yes.
Otherwise, it's a waste of money. Okay.
I
Well,
agree.
it's not, I tell people the best insurance is the one that's enforced when you pass, if and when you pass away.
Hmm.
Okay. But it's not the product, it's the strategy.
Yes. Yep. And with it too, but let's be real, most of the time these people aren't investing the difference. They don't know how to invest the difference. Or most of the time they're maybe working with like a financial advisor who really doesn't care too much about them because it's not their money. I only have seen people lose money when they start to lose the control of it. And people
Yeah.
who are just giving money over to their financial advisors and saying, hey, well, my guy's getting me a 7% rate of return. You are not calculating in all the risk, the fees,
Right.
the taxes that you got to also contribute to that 7, 8% that I'm getting within my portfolio. So I just think,
That year, right? Because here's the thing people don't realize, Hannah. Mutual funds do not earn compound interest, right? So there are people that will say they'll show the rule 72, right? So rule 72, you divide your interest in 72, interest rate in 72 will tell you how long it'll take for your money to double,
yep.
right? So if you're getting 7%, that means your money will double every 10 years. So I know people that will show that, and then they'll show a mutual fund um perspective, perspectives, or the chart. I forget the name of the chart, but they'll show the performance, and people think that's their money. That's just math. That's not how. Because the market goes up, the market goes down, and so you're not getting 10%, so you don't earn compound interest. It's just so many I call it Hannah, people don't really understand the financial physics around money. And so once you start to understand that, that was brings the power of whole life once you understand things like opportunity cost,
Mhm.
and wealth transfers, right? Because what happens is there's two schools of thought when it comes to money. And this is kind of out of Garrett Gunderson's book, The Killing Sacred Cows. So there's the most people are brought up in the what I call the accumulation theory,
Mhm.
right? Buy and hold, dollar cost average, get out of debt, modern portfolio theory, bottom investor difference. That's the accumulation theory. So even if they did invest the difference, it still doesn't work. Like, so, because all my people did invest the difference. I can tell you it doesn't work because, the whole idea of, in the company that uses it called the theory of decreasing responsibility, right? I call it the myth of self-insurance. Okay, because you're there's a book, it was a conference, I couldn't go to it, but Tom Wall's a book out called Permission to Spend,
Okay.
right? And so what the insurance does is gives you permission to spend or use your money. So when people say they want to, oh, I'll have enough money, I'm self-insured, I'll say, well, okay, let's test that theory in another type of insurance. So if you had a house, you have a house, right? I said to your if you paid your house off, would you drop your homeowner's insurance? No. Okay.
Never. No.
If you uh let's say your house worth 500,000 and you had a $500,000 in the house fund for your repairs and
Mhm.
you paid the house off, would you drop the homeowner's insurance if you were self-insured? No,
No, I
right?
wouldn't. No.
Because with the insurance transfers the risk to the insurance company, and that frees up that $500,000 for you to enjoy it because you transferred risk. And so property is property, right? And so it's the works the same with life insurance. It gives you permission to spend your money because at the end of the day, uh, your the death benefit of the life insurance will give your family a tax-free fill up of the money bucket.
Yep. Yep. And two, there's just a lot of people with the misconception of, well, hey, I'm not going to buy whole life insurance because my agent's just going to make way too high of a commission on me. I
Yeah.
want to hear your perspective when people come to you like with that little nugget. What was kind of your response to it?
I said, listen, I show, you know what I'll do? I'll show both. I'll say, first of all, because the, we get paid once, okay, and people that do AUM, not God bless, there's nothing wrong with it, but they're getting paid forever, right? And the more your account grows, the more money they make, right? So you never calculate that. Whereas, when we create a properly structured dividend paying whole life, we're literally solving for, we call it minimum non-MEC, but basically how little insurance would IRS let you get away with. So we are actually de-emphasizing the death benefit. We get paid on death benefit, right? And so we're really backing out a lot of times 50, 60, 65%
Yeah.
of what gets paid on. So I get that. Like, so if you're just buying what is called, I'll use base only, the way regular agents sell it. Yeah. I mean, and they're not even selling it for the commission. I mean, that's just what they've been trained in. So I'm not throwing them under the bus, especially people that sell a whole life. And
Hey, can I
and-
even add too?
yeah.
100% base premium policies are not a bad thing. I think that's another big myth
Yes.
we need to really start debunking too.
Yeah, you know what? I'm getting some counseling around that now. Right? So, because it's because I'm in a group, there's a bunch of leap guys in a group I'm in.
Yeah,
So
yeah.
that's what they do, right? So it's like, okay, there's not, they basically said the same thing.
Hmm.
And leap is another like a economic system guy for you don't know. But what I like is that we all believe in whole life at the core of of the core of your financial universe
Yep.
should be, you know, because there's an economic value of certainty, right? So you want to be the wealth creator. You want to make sure that what if you could make sure that under everything you do, under all your investments, under your private lending, under your business, you could guarantee. That's a word I used to not be able to say, right? When I was in the Regia Rep, you couldn't get me to play a word game and say guarantee,
Mm,
right? This is illegal, but we can guarantee that every year your personal economy is going to be more liquid. It's going to be stronger than the year before because every year you have access to capital, uninterrupted compounding,
yeah.
right? So, and here's the other thought. I forgot my thought. So there's the accumulation theory, right? But on the other side of that, there's the velocity method,
Uh-huh. Uh-huh.
right? So what do they teach? So if you took a corporate finance course, they don't teach buy and hold, dollar cost average, get out of debt. buy term investor difference. What do? They focus on velocity, money multiplier. Sound familiar, right? Velocity of money. They focus on cash flow. They focus on leverage. And banks and institutions buy permanent insurance. And so here's basically what I found out, Hannah, is that those strategies work in personal finance
Mm-hmm.
and
That's
they're safer and they give you more liquidity, use, and control of your capital, right? So, I tell people, look, don't do what the banks tell you to do what they do.
Hey, Money Multipliers, pardon the interruption. If it's been a while or if you've never seen my presentation on the infinite banking concept, what I like to call the Money Multiplier method, click the link right here, themoneymultiplier.com/presentation. I'm telling you, this information is going to drastically change your financial life. All right, let's get back to the episode. Yes, just mimic and imitate what the elite and the wealthy are doing. I say that all the time when I travel and I speak live or do my television appearances. Literally, just mimic and imitate what those people are doing that you want to live the same lifestyle that they're living. Ask them
Right,
the questions.
right.
I know you can't really ask a bank what they're doing, but this is why you can go Google stuff. BOLI, BOLI, stands for
Right.
bank-owned life insurance, and really see what these banks are doing, because you can go and find these statements, the financial statements of these banks, and you will see right underneath their tier one assets, it says cash value life insurance. And
Yep.
cash value life insurance, it's whole life. No, banks are not buying IULs. They're not buying term life insurance. They're doing this because they understand the appreciating assets of what a whole life policy is. Because, Curtis, you hit the nail right on the head. We can say that it's an appreciating asset and that it has the guarantees because it is a guaranteed contract between you and that insurance company. It's written in there within that verbiage. And I think a lot of people miss that, because here's
Yes.
another big myth that people come to me saying, well, hey, I don't want to do this because the returns are low. There's not as much rate of return that I can get in this policy. Why would I get a stupid 4% in my policy when I could go out there and do lending deals? Because, right, I'm a lender. Got borrowers who are willing to pay me as much as 18% to use my money. So why
Right.
would I put my money in this stupid life insurance policy and not just give it to this borrower at 18%? What's your
What
thoughts
does
on
what does Nelson say? Nelson says your wealth has to be warehoused somewhere, right? And so the question I ask people is, where do you store your cash?
my bank account or my
Right. And
401k?
see, so now I got a high yield account. Okay. But when you take money out of that high yield account,
What do? You withdrew it.
you withdrew it. So there's nothing in there. So you're not earning anything. Okay. So yes, it's in the real estate or in the deal, but what if, I don't know, what if you could have your cake and eat it too? Right? What if you could leave it where it was and you collateralize your cash value, you loan it out to the other thing you want to do? Well, okay. So if you are getting 4% and you loan it out at 8%, oh, I don't know, that's 100% return,
Agreed.
right? This is why I mean that people don't understand the financial physics or how banks make money,
Yes.
right? And so because what one of the things that I'll try to share is that you gotta, Nelson says, if everybody should be in two businesses, ones that gives them a paycheck and the banking business,
Yeah.
right? But so what I was listening to Bruce, what's Bruce's name?
Weiner?
Weiner.
That's how you.
Yes. Because he was on the Nelson Institute show. I just listened to him yesterday while I was walking. But he's been on my show. But I heard it's like we say you treat it's got to be like a franchise. Like if you can borrow the business model. It's like if you're listening to this in the real estate investors, you think that the real estate is the asset. This is why I'll test people. I said, real estate's the asset, but to the bank, what is it? Right? It's just collateral. Their asset is the note. So if you're a private lender, the real estate is the collateral and your asset is the note. So you got to, if you think of the policy as a banking system, but you respect it. You run it like a business. You pay yourself back with interest, economic value added, and you are a good steward
Yes.
of your resource. I tell you, you want to really just get this simply, read the richest man in Babylon,
Yeah.
and
Yeah.
listening to the banker, talking about that people don't realize that book's about insurance all the way through.
Uh-huh. Uh-huh.
It's not a bunch of little. I had this young girl. She was 20. Oh, I read that. I thought it was just stories. I was like, no, you go back and reread it,
Yeah.
right? So, and it's not. It's real. Real things there. Because I teach something called principles-based planning, and so my framework is principles. So I teach principles that help our clients become and remain financially free,
Mhm.
right?
Mhm.
Principles drive strategy. So principles are how you think all successful people, according to Ray Dalio, operate by principles,
Mhm.
right? 'Cause otherwise, if you didn't have principles, every time something came at you, it would be like, oh, I've never seen this before. So you got certain, here are your buy boxes, here are your money rules, right? Principles drive strategy. Kim would say strategy is what you do, right? Banking's a process, right? And then strategy buys, so principle, strategy, tactics. Tactics are the products,
Mhm.
right? And a tactic is something that you buy. See, so too many people out there, when we're talking about this, they conflate the tactic, the product you buy, with the strat. Oh, I want those banking policies. There's no such thing, right? And it's a way of thinking, right? Because
Yeah.
all banking is creating a pool of capital that you control
Yes.
that can move at cost to meet some needs you have. And you want to store your liquidity somewhere where you don't have to liquidate it to use it. That's all we're doing. It's really ain't no more complicated
It's
than
not
that.
rocket science, in my
Right.
opinion. And I
Right.
know because you can agree with me on this, is that it's just the mindset. I would say 75% of the conversations that I have with my folks, it's all mindset.
Yeah.
Yeah, we talk strategy, we talk premiums, we talk mapping it out, but honestly, it's just all in how you think and how you behave. Curtis, you'll like this. Right now, I'm in a women's book club.
Hmm.
We're currently reading the Psychology of Money. And in that book, Morgan Housel just talks about how, hey, how you behave with your money is all that truly it is in your financial success. It's not so much the strategies or
Right.
knowing when to buy, when to sell. It's really how you behave. Because just like if you take it back to like the Warren Buffett, hey, don't let emotion conflict in this trade that you're doing. And sometimes you got to almost like remind yourself that when you are being your own banker too.
Right.
You got to behave just like, as you said, this is my business. I can't steal from my business. I got to treat my business with respect. I sum it up and I like to say that money will flow and grow to where it's respected to.
Right.
You got to respect that aspect of your financial life.
Because if you don't respect it, it's not going to money. If do as Dan Kennedy said, money you don't respect it, it's going to go where it is. It's where somebody respects it. It's not going to come to you if you disdain it.
Mhm.
If you're a closet Marxist, you're not going to get any money. All right, let me stop. So you know,
Good though.
so but they don't even know. Go read the Capitalist Manifesto with Kiyosaki. Like most people don't even realize what they are because you've been brought up in the school system. So you gotta like if one of the things that I told this is bad. I told Nelson, I said, Nelson, you created a monster. Like he red pilled me. So if you read the book and you read the bibliography, you've been red pill. Like so all of a sudden you read Creeps from Jekyll Island, um Confessions of an Economic Hitman, and you just work your way through that stuff. You're no more good,
Yeah.
right?
Yeah.
And that's the thing. And because Nelson would say, if you know what's going on, you know what to do. See, most people don't know what's going on. They don't understand. One of the things where I lost my religion with equities personally because I got tired of. I lived through four crashes, and all I kept hearing was, "Well, the market's going to come back." And I was doing the teachers retirement plans with this company and this woman, she was 68 and then 9/11 happened, right? So she lost like 50 grand in 3 weeks
Wow.
that she didn't have to lose. And then when I looked at her stuff, I had inherited her and she was in all this unsuitable stuff that she should not have been in. And so the advisor who put her in that stuff was chasing performance, asleep at the wheel.
Mhm.
And so the wholesalers from Mount Olympus come brace our presence coming down from New York, and to the whole put some lipstick on his pig and sell it type people. And I told him the story. He goes, "Well, the market's going to come back." I was like, "Are you effing kidding me? Did I tell you she was 68? How
Yeah.
dare you tell me this nonsense?" So I that, and now, I'm reading Rich Dad Poor Dad now. I'm in the third book, and so I'm no more good. I don't know what to do with all this stuff yet, but I'm like conflicted. I'm just mad now. I haven't quite figured this out yet. And but I'm very crusade oriented, right? And so people need to know this. And I think that because the other thing, when you talk about the bad rap, I think people just don't, they're, because they don't, because one of the things you have to do, first of all, is you got to separate savings from investment. You got to
Yeah.
start there. Okay. So say, when I say savings, safe money, safe, liquid, accessible, guaranteed. Okay. So now when you define that, well, what does that? Savings account, CDs, money markets, cash value of life insurance. So you have to classify it properly. Well, it's not a good investment. Okay. It's not designed to be invested. I don't want the up to the market without the downside risk. I'm going to take risk in my business, right? In what I know. Because see, one of the things that we teach, Hannah, is we say, look, I teach the 5 principles of personal finance: save, maximum protection, liquidity, or full replacement of assets at death guaranteed, which is why I don't use one of the reasons I don't use universal life, because it's not guaranteed, right? Liquidity, 6 to 12 months, and velocity. So using your liquidity to buy or build assets that send you a check, because income follows assets, right? And so those are the principles. But then I was taught, and so I teach the 3 rules of investing. Okay. So rule number one, invest in what you know, or invest in knowing. Okay. Read a book, invest in knowing.
Yep.
Rule number two, invest in what you can control. Can you influence the outcome? Does it cash flow? And my third rule is don't chase returns.
Mhm.
So that keeps you out of a lot of trouble. And then most people don't know what investment is, right? So people say, "Well, I want to invest." I said, "Well, let me tell you what I call the investment, and let's see if we're talking about the same thing before I answer your question." And I said, "Have you heard of Warren Buffett?" They go, "Yeah." Okay, good. Have you heard of Benjamin Graham? And they go, "No." Okay, well, that's Warren Buffett's mentor. Him and they were Graham disciple value investors. I think they've modified it since then. But his book, The Intelligent Investor, which came out like 1944, the first chapter is speculation versus investing. This is a book about the stocks, but here's an investment. An investment operation is one that you deploy your cap. I'm paraphrasing, but one you put your money into where upon thorough investigation. So that boom, that leaves most people out right there. Okay, upon thorough investigation, you have safety of principle. That means you put in 50,000, you're supposed to get back 50,000 at least, right? And you have a reasonable opportunity to make a profit. If it doesn't fit that definition, you are speculating or gambling. So I say, look, now, if you hold that definition up to what Wall Street is teaching you how to do, are you investing? Okay, I'm not saying you shouldn't speculate. Just you don't know that you are speculating. You're speculating with 95% of your daggone money,
Yep.
and you can't get to it because you got a qualified plan. So it's and so I think that the bad rap comes from because they try to make, and the insurance companies don't help because they're trying to blur the line between savings and investing.
Yeah, I know. I know. I've even had some of my people call up like to the insurance companies. They said, "Hey, I tried to call up to one of the insurance companies. I made sure that it was mutually owned. They've been paying dividends for a long, long time. And I tried to ask for one of these infinite banking policies, but they said that they don't sell them."
Right.
Have you
Right.
heard that one before?
Yes. I mean, they don't, because see, we are the um, like the insurance, you're trying
Before
to build a,
time.
yeah, I mean, first of all, there's no such thing. They don't know what you talk about. They're the product manufacturer,
Yep.
right? We are the architect. You know, they're like the lumber, and you want to build a house. You need wood, but you need an architect to put the house together.
Mm.
Hannah and I are the architects, right? They're just the wood manufacturer, right?
Yeah.
Or the lumber yard because they, God manufactures wood. But what happens is, so it's no such thing because it's whole life, because people will call up and they'll call me, heard some little clip of something, and they go out and buy a whole life policy.
Yeah.
Oh,
Yeah.
I got a bank. Huh. Tell me about it. How much do you have? So if it's an even number, I
You
know it's
already know.
right. And then, well, it's how much, well, what's it cost? $250 a month? Huh. How long you had it? 2 years? You have any cash value yet? No.
Well, I
Okay.
got I got $49. What you
Yeah,
mean?
exactly. So, and they don't know because and I tell people, look, if you talk to somebody, an agent, and they don't literally beat you over the head with the book within like the first 3 minutes of the conversation, like you got to read this book, blah, 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 and literally, smack you over the head with it, they don't do it.
Or even bring up Nelson's name, in my opinion.
Yeah,
And it's not so much, because people are probably listening to this and they're like, oh yeah, that Nelson Nash guy, Colt, 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 almost, right? But it's like, no, we need to understand where these teachings are coming from. And everything that was pioneered came from our Nelson Nash. And y'all, I say this all the time, but he wasn't the inventor of this concept. Whole life insurance has been around for so long, late 1800s, right?
right.
So it's just of how we're internally designing this and using it to be our own bankers, to store the money, to protect it, and then being able to use it while we're living, the living benefits of it. But then, hey, that cherry on top of the cake, because it's not an if it happens, it's a when it happens, when that graduation date, my expiration date comes due, then my family's going to get paid out a tax-free lump sum check to themselves. Because let me tell you another one that I'll be real, I hate hearing this one. I don't need life insurance. You don't need life insurance when you retire. I don't need life insurance because I'm self-insured. Talk to me about your thoughts on that one.
Yeah, well, we talked about that, the myth of self-insurance, right? And so you are
With the house insurance
with the
and
house insurance. So it's the same concept with the life insurance, but also it's just like you, again, I call it gives you permission to spend your money. And so if you have term, because see, the problem is you could, you see, once you understand, here's the other side of that. Once you understand estate planning, you never not need insurance, right? You never, there's no such thing as having too much capital, as Nelson would say, right? Because if it's all in qualified money, you could lose over half of it to taxes by the time it gets past your spouse,
there you
right?
go.
So there's all kinds of little planning things you don't understand, and so you're just getting information from what the financial entertainers.
Yeah.
They don't they're doing giving you general information, and you should learn as much as you can, but it's not that whole thing. So I do the house when they say they're self-insured. I do the house thing. I talk to them about that. I want to get them because what I'm trying to do is draw a reasonable analogy of, okay, you because if you're trying to, because first of all, you're not. I tell people, look, if you have, I do this exercise called retirement ready or not, and I use it to show people that you can't save enough money. You can't accumulate enough. Most of the time, unless you're a really high paid executive, some people do it, but most middle income people, I had somebody that I said, listen, well, I'm 55. I said, well, if you had a million, how much you make a year? 110,000. I said, okay. If you had $1 million, bless you, would you be all right? Yeah, I think I would be. Huh. Have you ever heard of safe withdrawal rate? Uh, and I'll go, no. I said, what's 4%? What 4% of $1 million? 40,000. So you're a bit short. Okay. And so you got 10 years to accumulate like $2 million, right? And in a fluctuating market, saving monetary units called dollars that the longer you hold them, the less they buy. There's just a lot of moving parts there, you
Yeah.
know. And so they don't, you just don't know that like it's hard. So we're not saying don't do that, but you really got to understand, you got see, because the question starts with, because we're talking about, it's a book, Simon Sinek, it start with why,
Yeah.
right? So it's why, then how, then what, right? The product is a what. See, too many people lead with the what, but you want to start with what. What are you trying to accomplish? What does
Yes.
money mean to you? How do you know? Do you want to become financially free? Tell me what that means. Okay. Because IBC is a means to an end. It's not the end. There's no product in of itself that's going to take you to glory. It goes back to what you said before, it's your behavior, right? And so the product is not magic. It's you're collateralizing an asset. You can collateralize, you could use CDs to be the bank, right? You could use HELOCs. You could use, what's the other thing? Brokerage accounts, margin accounts. It just happens that properly structured insurance gives you the most benefits of your money. And so if people, we were talking about this before, right? If people actually knew the benefits, they would be lining up around the block to get it. But so you got people, because when you're getting financial advice, right? We I talk to people about, though, you heard of the four rules of the financial institutions, right? They want your money, they want it on a regular basis, they want to keep it as long as possible, and when do they want to give it back?
Never.
Never, right? So what's your goal? You want passive income greater than expenses.
Mhm.
Well, they're conflicting results, because that's not their goal is not make you rich. It's assets under management, right? So you're hoping, and hope ain't a good strategy. What's that movie with the Star Wars movie? Revolutions are built on hope. I said, well, okay, but financial planning is not. Okay, but it is. Most typical financial advice or the accumulation theory is built on hope, hopium. And so Hannah and I, when we talk about, uh, being in control of your capital, buying real assets, buying things that send you a check, you want certainty, right? Because Kiyosaki would say investing is not risky. Being uneducated is risky, because as your knowledge goes up, your risk comes down.
Yeah.
As your knowledge goes up, your anxiety comes down, because all of a sudden because people have a life, what does Dan Sullivan calls it, a ceiling of complexity. Boom, you're hitting your head against this ceiling. Oh, I got debt, I got this, I got that. And you might know two ways, and there might be 10 ways to solve it, but you don't know. So when you go through our process, we're educating you. And all of a sudden, as you see there's other ways to solve this problem, what happens to your anxiety? It comes down, because you have more choices.
And the clarity of it all. I just think that a lot of people they focus on the goal of what they think that they want, but it's probably not what they truly want. I think people really need to get very clear on their idea of where they are leading themselves down. I
Yeah,
also think that it's very important not just to focus on the end goal here, but focusing on the process and the systems every day, forming those daily habits that then it is going to get me to that end goal of where I'm trying to go. And I think that's a big one that I think a lot of people need to just spend more time on, because some people will say, well, hey, I'm busy. I got my kids. I got my business. I got a life that I'm doing, and I just don't got time to look at this stuff. Okay, but if you don't have the time to look at this stuff, nobody else is going to care more about this than you do, because this is
that's right.
your financial life and you need to get serious about it. Or you can be that person who's calling me up at 7 p.m. at night, who's a 69-year-old gentleman and he's just drowning in this debt. His qualified accounts are going down. He put money into crypto. Crypto's going down for him. And he's like, I thought I was doing everything correct. Now I'm 69 years old and I feel like I have to rebuild now. I have nothing to show for it. All of this work that I've done all of these years in my life. So I think my biggest message here about the misconceptions of whole life insurance is be careful on who you're getting the information from. I mean, my listeners, you guys have heard me say this before. Don't just take my word for it. Go out there and research other people, tune into different podcasts. All that I ask is, hey, make sure that they're an infinite banking concepts practitioner. And how you can find that is if you go to infinitebanking.org, there's a practitioner's finder on there. But go and see how other people are doing this in their lives and how they're explaining it. Because let me tell you, as being a Gen Z female and on the internet, I see a lot of the big gurus that are out there and what they are preaching and what they're messaging. Oh my gosh, Curtis, and speaking of, I saw this one guy. He was looking over a policy and it had paid up additions attached on. And he was like, this is stupid. Why are you putting money into whole life policy? What you should do is take all this money, do a 529 plan for your child instead. And then if they don't use that, roll it over into a Roth IRA. It's just like people,
Right, right.
they
You
don't
from a
get
frying
it.
pan to another frying pan. I mean, that's what I mean. It's typical accumulation theory advice, based upon because they've been trained by the product manufacturers, right? And so because that falls right back into the four rules. They want your money, you want a regular, and so the other problem is they put money into what I call little silos, right? 529 for 401k in little silos where they can't touch it. So all of a sudden, because you don't have access to your capital, you got debt and you don't because when people don't have if they got less than ideal credit, they have got non-preferred debt and no savings. Those are symptoms, and we talked about this on our show, of bad cash flow control. And so you don't have access to money. So instead of putting money in little silos, we like storing it in policies where we get access to capital and uninterrupted compounding so that if a emergency I call it in my system a major capital purchase, anything I can't pay for in full within monthly cash flow, or an opportunity comes up, I can get to money with a fax or a phone call. And that's what you want. That takes pressure off, right? And so what's your peace of mind fund? I mean, you talked about last time, like you like to keep no more than 90 days in the bank and the rest of it goes in your policies, but you're very liquid and you don't want to borrow more than a certain level so that you're not redlining the policy.
Yes, correct, correct. And lastly, what I'll even say too is the whole mentality of, oh, this is a scam. There's no way that you can do that. So, last thing I just want to leave the listeners with is that really follow and see what the people advices that they're giving you. What are they doing in their own life? Have them show you your portfolio. I've shown people my policies before. If you really want to see my policies, I got you. I'll show you them. I do it all the
Mhm.
time on my YouTube channel. I was just
Mhm.
showing the eighth policy I'm about to start, which is about to be my biggest one. I think after that, I think I'm going to be maxed out for quite some time. I
Okay.
got to start making more income
Right,
to
right, right.
more and
Oh,
more.
that's coming. I won't out for long, I'm sure.
But I think this is good. I really do value Curtis, his opinions, and just what you are over there doing, my guy. I mean, you are really helping changing people's mindsets, their financial lives, and it's important. It's important work because it's not, again, it's just not rocket science in my opinion. I know people can kind of get mad at me when I say that, but it's because of how much I understand what a dollar is and
Right,
how money transacts. It's all we're doing is that we're just warehousing money. You got to warehouse the dollar somewhere. And then through that pool of money is how I go and buy my transactions, what I'm doing in life. And you can't put a price tag on a peace of mind. I
right,
think
right.
there's no price tag that you can put on that.
Girl, you're so much smarter than I was at your age.
I appreciate you. Hey, where can people find you though?
So go to the YouTubes at Curtis May, or just search for the Practical Wealth Show, or our website is practicalwealth.net, and you can kind of see some of the shows we've been on, what we're doing, what is principles based planning, and so all I do is kind of put a planning wrapper around IBC because I think there's other stuff that you should, or do you have a trust? Do you have so we kind of walk people through making sure they're, kind of have an order to this stuff. And but I listen, this is y'all need to get with her. All right, if you're listening to the show, and if you want to hear more madness that is Curtis, check out my YouTube channel. And I'm a bit hype. I was relatively calm today, but I get a little bit hype, or I'll go on a Curtis rant, a Curtis libertarian rant every now and then. So, but we have fun with it, and or I'll go into Coach Curtis mode, right? So Coach Curtis is not always a nice man. So I coach basketball and soccer and that kind of stuff. So, if you're not performing right, I'm going to make you do wind sprints, right? We're going to do suicide, get on the line.
Burpees.
And so I will do that with you with your money, right? And I'm going to, let you have, or I'm gonna make you tell me, all right, well, why do you, somebody asked me something. And I was like, well, why are we doing this? I said, well, you tell me. This is this morning, matter of fact. Why, because I wanted her to get more term insurance. Why am I doing this? I said, well, you make more money, you just had a baby. What do you think? Why are we doing it? Right? And because take your income multiplied by, you're 36, I'm 25. And so I'm getting you up to that, and then I'm expecting your future is bigger than your past. So we need places. I want to lock in your insurability and make sure that when you have more money, we got a place to put it. That's why we're doing it. Okay. And don't die for free. That's the other thing I said. I'm working in a lot in the black community. It's like, stop dying for free. You talk about you want to create multi-generational wealth. Well, it starts with life insurance, damn it. Then you get a trust and the other stuff. But you start with that. And then it starts with you have to learn to be a good steward of your resources. So when I talk to people, I'll end with this. My goal is what I call the 4 pillars of a strong personal economy. Pillar number one, freedom from debt to others. Not get out of debt, be the bank, right? Because 35% of every dollar is leaving your household, so get in control of that. Pillar number two is ready cash, right? So you want to have access to capital. Pillar number three is passive income. And I like to say asset-based income because I don't want people to think it's coming from a product. So I want you to buy assets. Asset-based income you don't have to work for and you can't outlive. And the last one is a legacy of wealth and wisdom, which means that you need to teach this. We know we've got colleagues that talk about and do family retreats, and family banking. Kids come to you and they gotta give you a business plan and you loan money, for that kind of stuff. So it's got to be a way of life, and I think that that's a big message because you build community from the bottom up, not from the top down. So it's not going to come. There's no political saviors. There's nobody going to save you. You have to save yourself because you can't control the economy at large, but you can control your personal economy, which is your production and consumption as a family unit. And that's what you need to control.
Yes. I'm gonna leave it at that. That was a mic drop.
That's good stuff. Yeah. Hey.
All right, and hey, y'all, what I'm gonna do too is I'm gonna put Curtis's information down in the show notes down below. So go check him out, see what he's up to. And Curtis, my man, I'm gonna see you here in just a few short weeks.
Florida. That's
Good.
right. Yes.
Coming
That's it.
on. I told y'all, isn't he funny? Isn't he kind of cool? So, hey, if you haven't done so, go and give Curtis a follow. Check out some of the stuff that he's doing. And hopefully this was able to provide some insights when you go down the rabbit hole of IBC and get into the world of IULs and buy term, invest the difference philosophy. Really think for yourself and question. If you are a regular listener here, you've heard me say that before, but nobody's in the same financial boat that you are. So what works for you? Get clear, set your intentions, and don't be afraid to ask for help. That's why I'm here. So send me an email, podcast@themoneymultiplier.com, and you'll get in contact with me. We can schedule a call, we can chat, we can just talk about what is going on in your financial life at this time. So, seen it all, folks. Trust me. In my youthful years, I've seen a lot. So, I hope to see y'all next week for another episode. And hopefully this year too, come and catch me on the road. You can go see all of our live events of where we're speaking at, themoneymultiplier.com. Go to the events tab and you'll be able to see us. We may be in your town or close by and we can hang out together. So thank you, Money Multipliers. I'll catch y'all soon. Bye now.